my name is Irina, and I'm an internationally recognized legal expert with over 20 years of experience in legal advisory. realLaw is an AI assistant for UAE laws. We have gathered all federal legislations, emirate-level laws, and free zones regulations in one place, and trained our AI to answer your questions with reference to the specific articles. You just ask, and you get the answer right away. And today we are launching a new series, a monthly digest of changes in the UAE legislation. Every month, we briefly break down what's been adopted, what's changed, and who affects business owners, experts, lawyers, accountants. By the way, the full presentation with all the laws we'll cover today is available for free download. The link is in the description below the video. April was, to put it mildly, packed. 9 documents, from tax amendments to rules for crypto exchanges. If you run a business in the UAE or you're planning to, watch until the end. Something here almost certainly applies to you. Today we have 6 big blocks: taxes, and there is a lot of those: consumer goods, the banking sector, commercial companies, virtual assets in Dubai, and finally real estate in Abu Dhabi. Let's go. Let's start with taxes, because April brought the most changes in this area. 4 separate documents. We'll go through them in order. The first document is Cabinet Decision number 17 of 2026. These are amendments to the executive regulations on tax procedures. Sounds boring, but there are details that really do affect your day-to-day operations. 3 main topics. First, voluntary disclosure. If you have spotted an error in your return, what you do next depends on the amount. If the error is more than 10,000 dirhams, you are required to submit a voluntary disclosure within 20 working days from the moment you became aware of the error. That's a hard requirement. No, we'll deal with it later. If the error is up to 10,000 dirhams, you can correct it in your next tax return. Voluntary disclosure is only needed if there is no return through which the correction can be made. Second, document retention period. If you have filed a refund claim with the statute of limitation and the FTA hasn't yet issued a decision, the retention period for all related documents is extended by 2 years. People often forget about this, and the fines for missing documents can be quite painful. Third, refund of overpaid tax. The FTA is now required to issue a decision on a refund application within 20 working days, and the actual transfer of funds within 5 working days after approval. That's good news. Previously, the timeline were a lot less defined. The second document concerns those who work with excise goods in so-called designated zone. This is Federal Tax Authority Decision number 1 of 2026. This one matters for warehouse keepers and taxpayers. A new report must be requested within 30 working days after the previous one expires. If you miss that window, the new report will be valid from the date of issue, not from the date of previous one ended. So you'll have a gap in coverage. Watch your deadlines. The third document is FTA Guidance CTP 010. It deals with the Article 36 of the Corporate Tax Law, the article that regulates payments to related parties. Under this article, any payments to directors and officers of a company are deductible from the tax base only at the market value of the services. Makes sense? But who exactly counts as a director? Or who counts as an officer? A director is a person who sits on the board of directors or a similar governing body. Important nuance: just having the word director in your job title, for example, sales director or operating director, doesn't make you a director for the purposes of the tax law. You need an actual seat on the board. An officer is broader. This includes the CEO, CFO, COO, and other people with a real authority to make strategic decisions, sign binding agreements on behalf of the company, and manage its operation. A person without the authority to make final decision is not an officer. Middle managers who execute decisions but don't actually make them, they don't fall under this category. One more point. Only a natural person can be a director or officer for these purposes, and if a person is both a connected person and an affiliate at the same time, they are treated only as a related party. Practical takeaway. If you are paying someone whose title is director but who doesn't sit on the board, check whether they fall under the officer definition. It changes how you should structure the payment. The fourth tax document is a nice one. Cabinet Decision number 129 of 2025 has reduced a whole range of fines. It came in force on 14 April 2026. In short, fines have become smaller and more logical. For example, the fine for failure to submit documents in Arabic was reduced from 20k to 5k dirhams. For failure to notify changes to your tax record from 5k, 10k down to 1k, 5k. For failure to notify the appointment of a legal representative from 10k to 1k dirhams. An incorrect return, a flat 500 dirhams. A significant change is the logic of late payment penalties. It used to be 2% per day plus 4% monthly. Now it's a single rate, 14% per annum charged monthly. Much easier to calculate and, on short delays, generally milder. Voluntary disclosure penalties have also changed. The old scale went from 5 to 40% depending on the delay. Now it's a flat 1% per month on the tax difference. And if you fail to disclose before an audit begins, instead of 50% plus 4% per month, it's now a fixed 15% plus 1% per month, much more predictable. Moving on the second block, consumer goods. One decision here, but with very specific numbers. Cabinet Decision number 14 of 2026 introduces administrative fines for breaching pricing rules. It applies to everyone, retail, wholesalers, online commerce, including e-commerce. The presentation has a table with 3 categories of violation. Let's go through them. First, raising price without the ministry approval. First time, warning. Second time, 20k to 30k dirhams. By the fourth violation, 50k to 75k dirhams plus a 30-day shop disclosure. From the fifth time onwards, fines double and a permanent closure becomes a possibility. Second, collusion between the supplier and seller to raise prices. This is more serious. First time, a fine of 25k to 45k dirhams. Straight to money, no warnings. Fourth time, 85k to 100k dirhams plus permanent closure. Third, false price information or concealment of pricing information. First time, warning. Fourth time, 35k to 50k dirhams plus a 30-day closure. Important details. The violator has 30 days to appeal from the moment they receive the notice. The decision on the appeal also 30 days. If the deadline passes without a response, it's treated as a rejection. If you work in retail or supply, this decision is worth reading carefully, especially the part on e-commerce. Online sales are explicitly named in the text. The third block, banks and insurance companies. The UAE Central Bank issued Circular number 5 of 2026, the regulation on employee remuneration. This is not about how much to pay people. The central bank explicitly says we don't send a specific amount. It is about the system, about how decision on compensation should be structured so they don't create excessive risks to the financial system. The logic is simple. If employees get huge bonuses for short-term results, they have an incentive to take risks. The 2008 financial crisis was partially a story of exactly those incentives. The UAE wants to avoid that. 5 key requirements. First, the remuneration system must match the size, nature, and complexity of the business. A small bank and a large systematically important one, different requirements. The central bank applies the principle of proportionality. Second, payments must be aligned with the actual performance and with the level of risk of the employee has taken on. Not just target hit, but target hit without creating hidden risks. Third, clear rules for the variable components, bonuses, no excessive risk taken for short-term gain. Fourth, and this is the most interesting from a practical standpoint, the clawback mechanism. The ability to recover remuneration that has already been paid out. If something goes wrong, the bank can demand back a bonus that's already have been paid. That's a serious tool of corporate discipline. Fifth, separation of responsibilities. The board of directors, ultimate responsibility. The remuneration committee, independent oversight. The risk committee, capital adequacy assessment. Each body has a clearly defined role. Bank and insurance companies need to check whether their current system meets all of these requirements. The central bank will be assessing this. The fourth block, for those who deal with the private joint stock companies. Ministerial Decisions 83 of 2026 changes the lockup rules. the period during which share transfers are restricted. Quick context. Under the Commercial Company Law, once a private JSC is registered, there is a period during which shareholders cannot sell their shares. That's there to protect investors so that the founders can't exit the company right after raising capital. The new decision makes those timelines more flexible. There are 3 ways to shorten the period. First, if the company has published quarterly financial statement audited by an auditor for 2 consecutive periods, the lockup is reduced to 7 months. Second, if different classes of shares are introduced and placed with the professional investors outside of a private subscription, the period is reduced to 6 months, but only for those shares. Third, if an employee share ownership program is adopted, also 6 months, only for the shares under that program. In addition to shortening the period, there are also cases of full exemption from the lockup. For example, bringing a strategic partner with a stake of 10% or more, capital restructuring, the execution of a court order requiring a forced sale of shares, or a number of other explicitly listed cases. For any of these events, you have to notify the Ministry of Economy and update the commercial register within 10 working days. Miss that, and there is no guarantee the exemption will be recognized. One exception: if the company has already placed securities through a private subscription, is listed on the security financial markets, this decision doesn't apply to it at all. It's already fully exempt. The 5th block, crypto and virtual assets. VARA, the Virtual Assets Regulatory Authority of Dubai, has adopted its exchange service rulebook. A new chapter has been added, Part 5. Exchange-Traded Derivative Service Rules. In plain term, rules for ETDs, exchange-traded derivatives. If you don't work with crypto derivatives, this part is just informational. But if you do work with them, or you're planning to, listen carefully. 4 key blocks of new rules. First, access to ETD services. Only VSPs with a valid exchange service license from VARA can offer them. No DIY launching or derivatives products, only through the license. Second, client assessments. There is a detailed list of suitability criteria for checking retail investors before they can trade derivatives. That's serious consumer protection. ETDs are complex, high-risk instruments. Third, segregation of accounts. ETD accounts must be strictly separate from the client's accounts. No commingling of funds. Fourth, insurance funds. Every VSP that provides ETD services is required to establish and maintain one. There is buffer in case something goes wrong. Special mentions of perpetual ETDs. These are derivatives with no fixed expiry date, perpetual contracts. There is a special regime of those. VARA has also gained an expanded toolkit for influencing market participants. Regulatory oversight is tightening. That's a general trend of the UAE crypto industry. The final block, real estate in Abu Dhabi. Several documents that have been added to the realLaw AI database. The first one concerns rights of common areas of properties. Decision number 24 of 2025. It regulates who owns, uses, and manages common spaces, elevators, lobbies, parkings. It defines the responsibilities of the management companies. The second, decision number 165 of 2025. It deals with the use of funds from escrow accounts during construction. Developers can now access buyers' money before construction is complete, but only after reaching 20% of completion of the project and subject to a number of conditions and guarantees. It's a balance between the developer's interests and protection for the buyer. The third point, refunds to buyers when registration of an off-plan unit is cancelled. There is now a clear procedure under Article 17 of Abu Dhabi Law No. 3 of 2015. And finally, tightened requirements for holiday homes, short-term rentals. The criteria for classifying properties and the conditions for license renewals have been expanded. If you have an apartment in Abu Dhabi that you rent out for Airbnb or similar platforms, keep an eye on the updates. So, to wrap up, April 2026 brought 9 new documents across 6 areas. In taxes, softer fines, new timelines for voluntary disclosure and refunds, and important clarification on corporate tax. In consumer goods, specific fines for pricing violation, e-commerce included. In banking, new standards for compensation system with a clawback mechanism. In corporate law, more flexible lockup periods for private JSCs. In crypto, new rules for ETDs under VARA's supervision. In Abu Dhabi real estate, regulation of common areas, escrow, and short-term rentals. If you want to dig into any of these documents in detail, all the legal texts in English and Arabic with translations are available on realLaw AI. The link is in the description. And don't forget, the full presentation with all the documents we covered today is available for free download via the link in the description. Save it, share it with your colleagues. This is the first issue of the series, and your feedback genuinely matters to us. What was useful? What topics would you like to dig into more deeply? And what to add in the future issues? Write in the comments. We read everything and will take it on board. Subscribe to the channel so you don't miss the May Digest. Thanks for watching. See you in a month.